Would be a shame if anything happened to it. Please pay me some insurance. And it really is moving from a win-win commercial transaction, in a sense, to an extraction, an exploitation. And a way to see this is, think about the defense guarantees being weaponized to say you have to do this kind of purchasing of U.S. arms or goods, you have to do this kind of agreement on military spending, but even more so, we're not going to guarantee anything. At any moment we can renegotiate and take it away. And that's the act of a gangster, not an insurer.
So then the question for me, there's a lot of questions that come out of that, but how do other countries react to that new reality? We can dive into whether that's a justified perception about being ripped off or not. You've made clear that you think it's not. But how does the rest of the world, should they or are they reacting to the idea of the world's largest economy now being a rent extractor, as you say?
Well, I think there's three major themes. One is just, it's a huge surprise, frankly. Even in Trump 1, even under Biden, there was a sense that the insurer was getting it to be a little bit more hassle when you filed a claim, the premium were going up, coverage was shrinking a bit, but this is a different world. And so this realization, I was in Ottawa, I was in Berlin, I was in Tokyo, I was in Seoul, this realization that things people had counted on just can't be counted on anymore. And this shows up in financial markets, this shows up in trade deals. And so what the concept that I think is coming into play is self-insurance, that countries are deciding, as a lot of developing countries or countries that didn't have close relations with the U.S. used to do, that it's a scary world, I can't depend on them, I may not be able to prevent problems, but I'm going to do my best. I'm going to diversify, I'm going to not be reliant on the U.S., I'm going to have alternative sources for money or to sell my goods, or just have more defense at home and more production at home. The second theme is what I call the irony of the alliances, which I coined after the article, frustratingly, but it is, so I appreciate the opportunity. But it came out of my conversations with other governments, businesses, investors, that the countries that are closest, think of Japan, Canada, UK, for example, that have the combination of economic and security ties to the US, they're the ones who are actually now being ripped off the most. I mean, the UK's got a temporary buy because President Trump likes going to Windsor Palace. Fine. I wouldn't count on that. But, like Japan thought was all in on the idea, okay, change the premia. We'll buy a useless shell of a company like U.S. Steel. We'll put in technology in the U.S. We'll invest more. We'll retreat from solar economics with China. If you treat us nicely and have us inside the Fortress America. That's how they were approaching Trump too. That's how they approached Biden, but especially Trump too. And they, of course, have been cruelly disappointed that they're not being treated as insiders. They're not getting rewarded for or at least recognized for their security contributions. And so I think, in a sense, the closest ones, UK, Canada, Japan, South Korea, Australia, arguably a couple others, New Zealand, they're the ones who are suffering most because they feel they have no choice. They have to go with the U.S. no matter what. And the Trump people seem to recognize this and seem to think that's an opportunity for exploitation. And then, as I know you're well aware of, we see the opposite with China or Russia. They've been deliberately diversifying away from the U.S. They've had less benefits from economic contact with the U.S., so they've been moving money out of dollars into gold, out of U.S. payment systems, finding new markets, writing off exporting large amounts to the U.S. And so they're worse off in a world like this, but they're much less worse off than our allies.
They're equipped to deal in a world like this and preparing for it.
Yeah. And the final thing I would say is the tendency is for these things to interact. So sometimes Trump officials will say things that are akin to what I'm saying, except they'll just say, this is just a repricing. Or, what do you expect? This is how we're the imperial power. This is how we should behave. And they don't seem to understand, in my view, that this has lasting repercussions. Countries make choices. And so if you, as again, I know the Atlantic Council and you have dealt with, if you talk to NATO allies, they're thinking completely differently now than they were a few years ago. They want to have a Eurofighter and not an F-35 jet. They are buying hedges on U.S. dollar assets in a magnitude that they had never thought to do, at least not since the late 70s. there's a whole cascade of issues. And then, of course, the institutions like the IMF, the World Bank, the WTO, the Bretton Woods institutions. They know they now can't count on the U.S. to support them. I mean, there was always the question around WTO for the last decade.
Now for the fund in the bank.
Now for the fund in the bank.
My question is to think about this and the profits question, because this seems fundamental when we talk to the Trump administration. I know you do as well. And sometimes I hear what you're saying from them of we're extracting a higher price because of risk. But sometimes I hear something a little different from them, which is the system was broken. And so if we're breaking the system more, so be it. Are there risks associated with that? Yes. But this will be better than the system we have lived under and tolerated over the past decades. I think you disagree with that, but I want to tease that out a little bit.
I appreciate your raising that, and there are thoughtful people either in or associated with the Trump administration who have that point of view. I think it is fundamentally mistaken. We have an environment where the U.S., certainly since the Cold War, has had extreme dominance over security affairs, getting to determine the fates of other nations and getting a great deal of obeisance from its allies in things ranging from UN votes to military deployments. We have had incredibly cheap funding for our incredibly rising public debt. People have been lending money to the U.S., in particular U.S. Treasuries, in ways that do not make economic sense on a vast scale, and it's worth billions of dollars in terms of new resources to the U.S. and missed payments. People, countries, businesses have acceded to U.S. business standards. There are all kinds of things on which the U.S. companies, like in the payment system where you're an expert, the U.S. companies, MasterCard, Visa, others, play an outsized role.
Of course, you set the international rules.
Set the international rules. I mean, not in everything, but in an awful lot of things. We have moved up the value chain, even if you're obsessed with manufacturing. The fact is we're producing as much high value added industrial products now, in fact more than we used to with fewer people. So it's a productivity gain, it's a moving up the chain, it's not a backwards. Our colleague at Peterson, Robert Lawrence, has written about some of this. Anyway, just on and on and on. So there are two possible threads of reasonability in their position. One is very narrowly national security. Did the U.S., did the neoliberals pay too little attention to concentration risk, like getting all your semiconductors from Taiwan or getting all your pharmaceutical inputs from China? And the answer is yes.
We're living that this week.
We're living that this week, and that's real, but that doesn't require you to turn upside down the whole world system. That's a fixable mistake. That, again, fits under the repricing, rewrite the policy. The second thing is, just as my colleague Morris Obstfeld and others have written about, trade deficits are not bad. Trade deficits are bad if you're in a fixed exchange rate system, you don't have a reserve currency, and people don't want to invest in your country. Trade deficits are good if they represent people wanting to invest in your country, which has been the case for the U.S., again, since Volcker stabilized inflation in the mid-'80s. So I know I'm supposed to in Washington say, well, they have a point, well, they're thoughtful, but they're just fundamentally wrong. No matter how many people believe it in Congress, no matter how many people believe it, the U.S. has not been ripped off by the world system. Even with respect to China, choices about not confronting them on, say, their currency manipulation or their military projections in the South China Sea were policy mistakes by the U.S. They weren't systemic.
So I want to talk about reserve currency. You mentioned reserve currency. You talk about this in the piece, and I think there's a debate here at the IMF compared to what you say and others think versus maybe where some at the fund are, which is what happened post-Liberation Day. The relationship between the dollar and treasury yields, that had a fundamental shift.
Right.
And I think when I talk to a lot of people here, they feel that that is not long-lasting. Something happened at Liberation Day. Yes, there was a different dynamic than we usually see. The dollar operated more like other currencies around the world, not the reserve currency. But that doesn't signal some fundamental shift away from the dollar. You seem to think a little bit differently, at least about the relationship between treasuries and the dollar.
Well, thank you for summarizing the facts, which is right. I would amplify the facts by two further points. The first is what we have seen repeatedly is on 6 occasions now, roughly speaking, where there was scary news about the U.S. economy and we saw an emerging market type dynamic. The currency went down, the 10-year treasury rate went up. And usually when there's scary news about the U.S. economy, the treasury rate and the exchange rate move down together and then come back up together. And, so it has happened repeatedly. Now, again, the intellectually pure logic, just because something happens every day, doesn't mean it necessarily is going to happen again. So on a basic logic point, this isn't proof. But there are other things going on. So Ellen Ray, a very distinguished international economist at London Business School, published a study a few months ago using really heavy-duty econometrics to make the point that I make with my chart in foreign affairs, but much more sophisticatedly, much more robustly. And there really is a change in dynamic. It's a very different dynamic intraday, intra-week for the dollar on a recurrent basis. But the second point, which I think is more important, is this hedging. We don't have great data, but all the data we have says that reserve managers, large pools of investment, long-term investors like pension funds and insurance companies are buying more dollar hedges on a scale we've never, I shouldn't say never, but we haven't seen for decades.
We hear the same thing, but it just hasn't shown up in the data yet. But we'll
it's
see.
shown up in bits of the data. All the data that we get on that does show it.
Yeah.
We just don't have definitive universal data.
That's right. I think that's right. But it doesn't seem like the fund, at least, and others here
Right.
have really wrapped their head around that
And
the level it
I
could work.
think it's understandable, just as it's understandable but unfortunate with surveillance in general at the fund, that they don't want to provoke a panic. They don't want to embarrass a government by causing a market reaction, and particularly in the case of the U.S.
Right.
So they are cautious, and there is, as I said, reasonable excuse to be cautious. I don't think full justification, but reasonable excuse to be cautious. But I think we're already seeing large shifts. I think it's not all specifically Liberation Day or the Trump people. I think part of it is as part of the mass changes we've seen in politics in recent years across the high-income economies. People are more scared about fiat money. They don't like the U.S. government or other governments having access. So you see this move into gold, into alternative assets, into so-called real assets, into the small currencies that are seen as stable, like New Zealand, Norway, Switzerland, Singapore. So again, nothing's proven, but it all is what you would see if there was what I call a decentering of the dollar. The dollar's not going away, but everything that you would expect to happen is happening.
Yeah. One way we look at this at the council, we have this dollar dominance monitor project, is to look at the payment systems first as sort of leading indicators where countries tried to build alternative financial plumbing. You see their interest, and then perhaps over time, because the infrastructure is costly and takes a lot to build, you see some of the dynamics change, but it doesn't happen overnight.
Yeah, I mean, you're doing good work on that. My colleague at Peterson Institute, Martin Trezempa, is doing some work on payments, and also Nicolas Véron from the European side. What I would emphasize in that space is we're about to have the Trump administration go full-out push on stable coins, but stable coins from the private sector. And the Genius Act from Congress, supported by the Trump administration, prevents the Fed from offering a central bank digital currency.
We're the only country in the world that is prohibitive from researching one, let alone issuing one.
And the European Central Bank, China, and others are moving towards that. So again, what do we expect over the next couple of years? I expect a temporary burst into stablecoins, particularly if the Trump administration strong arms Argentina and El Salvador and some other Latin American weaker economies. But I also expect it to disappoint the projections that the Trump Treasury is talking about. And I expect there to be larger flows into the central bank digital currencies, particularly in Europe, in the euro area. Yeah. And if the Europeans will get off their own reluctance.
So I want to come back to the rent extraction part of the piece and talk about the post-Trump world.
Right.
And really ask you, is rent extraction a product of Trump? And the reason I ask this is because when we talk to other countries, I think they're thinking about this short-termism.
Right.
We're going to need to get through 3.5 years. We're going to need to play this game the way the rules are being dictated to us. But perhaps after that, and this is where some of the hedging comes in, we can reset a little bit. Do you think that's accurate?
I think it's a partially accurate picture of how people are behaving. I'm finding more officials, particularly in Europe, but also in Southeast Asia, who are, and even in the Middle East, who are thinking this is going to last. It's not solely people saying we just got to get through the next 3.5 years. But I think more importantly, it is potentially lasting and is likely to be lasting because these things, nothing's ever permanent, nothing's ever inevitable, but they do get self-reinforcing dynamics. So the longer that the US behaves this way, the more opportunities there are of formerly insured people finding out that their coverage isn't there or they have to make a payment under the table to get their claim. So imagine the following scenario, very appropriate for the IMF. The Fed has these so-called swap lines that are set up to quickly provide other financial systems with dollars if there's a run in their currency, if there's something like early COVID or 2008-9. The Trump administration has said, somewhat grudgingly under duress, but they've said, we're not messing with the swap lines. The Fed can run the swap lines. And the Fed, of course, says we're going to run the swap lines. But no responsible government, let alone one with memories of the Euro crisis or the 1998 Asian financial crisis, sits there and says, so say I'm in an emergency, there's a run on my banks, there's a run on my currency, I'm out of dollars, I go to the Fed. Do I really believe that at the last minute the Trump people won't say, oh, by the way, yes, you get the swap line, but sign here that you're going to convert so much of your currency to U.S. stablecoins and you're going to invest so many billion in the U.S.
So what do you do then as a country to hedge against that risk?
So unfortunately, you can do only a certain amount of hedging. The swap lines are a genuine benefit, again, win-win for the U.S. and for the rest of the world. And the risk is that the U.S., even more than they've done occasionally in the past, makes it highly conditional at a moment of extreme urgency. So you start exploring, as a number of developing countries are doing, Chinese swap lines. You start exploring, can the IMF, and the IMF is talking about this even though not very publicly, can we create some kind of swap line alternative for the countries that the Trump administration doesn't want to include in the swap lines? The Europeans, if they step up, particularly in cross relationships with the Japanese, with the Singaporeans, with the Malaysians, with the Gulf states, with other large reserve holders, could they provide alternatives? None of it, this is why the world's the worst place. None of it will be as good as, okay, the US has the swap lines, the Fed makes up the mind, it's unconditional, either you get it or you don't. But you can do things that get around it. And then when you talk about the permanence, and this is the reason, sorry, I meant to discuss this, is you start making lasting decisions. Like, do I encourage my banks in my country or my economic zone to do less dollar funding? Do I use regulatory supervisory to say you have to pre-position capital here and it shouldn't be in dollars? Do I discourage my companies further from borrowing dollars? Do I take my reserve assets and reallocate further away from dollars? Again, nobody except possibly the Chinese is dumping dollars on the market. You'll lose money, dollar isn't going to zero. But you see, again, hints in the data and in conversations, oh, gee, as that investment comes up in dollars, maybe I'm going to reinvest some of it in euros, in renminbi, in Swissy, and something else. And over time, if you have a banking system that's less dependent on dollars, if you have fewer borrowers in dollars, if a smaller part of your reserve is in dollars, then that gets its own momentum. And so this is what I mean about, I think it becomes, not permanent necessarily, but self-fulfilling, self-reinforcing to some degree.
So I asked you about the price, the U.S. is extracting, and we talked about the risk and what's happened in insurance over the past 80 years. But what's the backfire effect? You write about this in the piece, meaning, okay, the Trump administration has their view of the world's largest economy, we're going to extract our price for it. But you make the point that this is not going to work out the way they think. You just outlined some of the costs, but I think there are more.
I think there are others. So just the flip side of a lot of things we were talking about. So imagine a world in which you are essentially telling people they have to invest a lot in the U.S. in order to get access to the U.S. market, which is what the Chinese did. And the Trump people and some Democrats under Biden would say, well, we're just doing what the Chinese did. But the thing to remember is when the Chinese started doing that, China was actually pretty small. And China had a very high growth path. So the extraction of doing that may have been beneficial to the Chinese short term, but it was premised on the fact that they were not harming other people very much in a way that forced a reaction, and that there were many gains to be had. The U.S., even in the best scenario, even with AI, say, working out and the U.S. having a fundamental lead in AI, doesn't have that forward growth path. It's not going to grow at best, we're going to grow at 3%. If we're lucky, we'll grow at 2.5% average. It's not going to grow at 7, 8, 9, 10% for 20 years. Additionally, the harms are very big. I mean, people started going against China and pushing back, including U.S. companies, including U.S. government, in roughly the 2014, 2015 period, if not sooner. So by the time China got pretty big, there was pushback. May or may not have been the optimal amount of pushback. Maybe the U.S. should have been pushing back sooner. Better the U.S., as I know both you and I believe, should have been coordinating with Japan and Europe and the UK to push back in a unified way. But ultimately, the U.S. can't extract beyond people who are militarily dependent on them and economically dependent on them beyond the short run. Other countries will just say, this isn't worth it. And the key point that the Trump people, I think, mistake, and I wrote about this last fall in Foreign Affairs, is they don't think there's agency. They don't think other countries have agency. They don't think other companies and investors have agency. They think it's like an arms negotiation. That, like Reagan, Gorbachev. Trump will make a deal with Xi, Trump will make a deal with Putin or whoever, and that's binding, and that somehow all the companies and all the investors in that country and all the consumers will follow along. Well, as we're seeing with Canada, with Japan, with Germany, you can make a deal with Trump, and part of the problem is you don't rely on the deal. But even if the government says, okay, we're going to live up to the deal, they can't force their investors and their companies to do what they say. There's Korean companies are kind of upset that a bunch of their skilled labor that were here building plants to transfer technology to the U.S. were put in jail for 2 weeks. And that affects the decisions that politicians and investors and business leaders in Korea make. And even if the Korean government, which they don't entirely, but even if the Korean government says basically we got no choice, we have to go with the U.S., they can't force their investors to go into the U.S. They can't force their biggest companies to bet their entire strategy on the U.S. And so over a relatively short span of time, these people with agency, these decentralized economic decision makers, which exist even in China, are just going to make other choices. And so what happens, and we saw this in China, and we've seen this in the past in India and Latin America with these self-sufficiency drives, you end up trapping a certain amount of investment and a certain amount of exports, and then all the growth goes on around you. All the longer term stuff, all the business standards, all the meetings, all the business networks.
But this, I think, is so important, and because what you're talking about is the cost of the rent extraction, but if you talk to people in the Trump administration, they think they're winning. They look at what's happened since April and tariffs. They feel like a lot of countries have folded or at least negotiated more than they would have expected. They'll tell you that privately.
Absolutely.
And so they're internalizing this message that is very different than what you're talking about is actually this rent extraction model works. But you're talking about the costs that are not being seen but will develop in the near term.
Right. And I honestly don't know how much the Trump administration either ignores these costs because they only care about the next couple of years and how much they can extract, or because they have such a belief in the national security view of things that these economic actors are not long-term free the way I'm describing, which is the reality, or that they just misunderstand because they're thinking in terms of certain kinds of deals. But I mean, there's this huge irony, right, that Treasury Secretary Bessent, who worked for Soros and Druckenmiller in taking down the British pound fixed exchange rate against the European exchange rate mechanism in 1992 and made billions off it, somehow thinks that whether it's Argentina or the U.S., you can order people to keep investing in your currency and defend a currency level and defend an interest rate against all comers. How somebody who spent most of their career doing exchange rate trading thinks that's the case now especially since foreign exchange markets are so much bigger and the technology is so much broader. And that to me is just representative of the whole picture. So, I mean, yes, they think they're winning, but even there, right, on the tariffs, there were a lot of people in Europe who were upset with the EU essentially folding and not retaliating, including a colleague of mine at Peterson, Cecilia Malmström, who used to be European Trade Minister. It was great. My view is that was wise on their part. There was no point in escalating with Trump. The deal was going to be the deal. It wasn't going to gain you anything. But meanwhile, Europe can start doing things like making deals with CPTPP, making deals with India, encouraging China, Mercosur, encourage Chinese investment, encourage all the scientists and immigrants we're passing on in the U.S. to come to Europe, encouraging a lot of the universities like Esther Duflo and
what's his name? This week.
Yeah, just moved to the University of Zurich.
Yeah.
You know, you can do a lot. You can have, as American companies get rejected as the leaders of business standards and business networks, you can have Europeans or Japanese or Koreans, particularly Europeans, say, you don't want the Chinese, you don't want the Americans, let us set the standard. And so is it going to replace the U.S.? No, but they can do a lot, and they can gain a lot, and the U.S. will lose.
So we just have a couple minutes left. Let me ask you two final questions, because you brought up Europe, and I think a driver for Europe's decision-making in the trade deal was not macroeconomics, but it was security. It was Ukraine. And this, to me, gets to the premise of geoeconomics, why we talk about this issue. When I left the fund 6 years ago, they said, what's geoeconomics? And now I think that conversation has changed in Washington beyond. Is there more the profession needs to do, macroeconomics as a profession, to incorporate this thinking so we don't have the kind of divisions that I think are actually sort of intuitive to most of the world, but in the US and Europe, we probably have had the luxury of not dealing with in recent years?
I guess I'm a little different place than you, Josh. So first is, you're absolutely right. It was concerns about short-term security in Ukraine and keeping the U.S. weapons and intelligence flow going to Ukraine, even if Europe pays for it. But again, the reaction is, we're going to build more military, we're going to source more things internally, we're going to utilize and deal with the Ukrainian military to help defend our border, to help create our drone force. We're ultimately going to be more independent. Now, if the Trump people say, well, that's our win, okay, maybe. I think there was a reason for 80 years statespeople in the U.S. wanted European allies and to have forward force projection and be able to fight wars in Europe instead of in the U.S. But anyway, going back to your point about the profession, I think the one thing that the Trump people, some of the Biden people have rightly identified, and I mentioned this earlier, is the economists tended to underestimate the importance of concentration risk. That if you get too much of a given good or service from one particular country or region, that creates leverage dependence things. You should go back to Albert Hirschman's first book on trade from the 40s.
Beth Baltzan, one of our senior fellows, mentioned this the other day.
Yeah.
Yes, it's a great point. Yeah.
Well, I'm the one who told Ed Baltz to read it, I think. Anyway, but anyway, the point is, so there is a specific set of issues. I'm not sure, where I differ from you is, I think it is situation dependent. So it's not that everything in economics has to be transformed. But I do think that there are certain specific gaps that have to be addressed. And like my colleague who you know, Chad Bound at the Peterson Institute, is very active in trying to think about these issues.
Yeah, for me it's all about how a policymaker makes decision and the competing issues they wrangle with at the same time, and the profession reconciling with that, even if that's not going to dominate or change the profession. Final question, we're sitting at the IMF here. You've basically written this piece which is about rent extraction in a more bilateral world. It's the US going individually to different countries and saying, this is what you owe me. So what does that mean for the bastion of international economic multilateral coordination here for the bank and the fund and their role going forward?
Well, I think, and this is one of the frustrations that a lot of people had, was that multilateralism done too formally got to be paralysis, right? So in India or Brazil could say, no, we're not going with that, and just stall everything, or when you have a China-US breakdown. And this has been more visible at the IMF, at the World Trade Organization than at the fund or the bank. and a little more visible at the fund than at the bank. So I think one has to be somewhat pragmatic, and something that I and a number of my colleagues at Peterson have been working on, and I talked about this different places, is you want to do, it's not the best phrase, but you want to do plurilateralism in a multilateral spirit, meaning don't get hung up on the legalities of having every single member sign off and making sure every member is in the room. Go ahead with coalitions that make sense, but do it in a spirit that it's rules-based, that it's open standards of entry. It's what Fred Bergson used to talk about called open regionalism behind APEC and CPTPP. And I think that's the way forward. And the other piece, which I know you, from your fund experience, share, is the fund, the bank, the WTO have to provide services to their members. And that's another place where I think U.S. governments, U.S. administrations, both Democratic and Republican, even when we have great technocrats in charge, have not fully appreciated. For the vast majority of countries in the world, whether it's technical assistance, data, computer things, meetings to exchange ideas, convening, drawing attention to issues, a whole range of services. The bank, the fund, the World Trade Organization, all do provide value to the members. And I think that tends to get lost when the US or China, gets all hyped up about, are we being treated nicely enough? There are genuine services being provided, and I think the heads of these institutions know that that's a key part of their mission.
I think that's such a great point, and this is where the IMF and the bank have distinguished themselves from institutions like the UN.
Yeah.
Would say we are delivering for you, but they have to remember that, and they're only as strong as the membership has trust in them. And I always say, I said this when I was here, and certainly since I left, that's not self-perpetuating.
Right.
And we can only look back on the past 80 years so much and have to look forward. So, Adam, I think your piece does what is so hard to do in economic writing, which is to take what's happening in the moment, see the forest through the trees, and then distill something that intuitively, when you read it, says this is what's happening, but hadn't been described that way before. So congratulations.
Thank you for that. Thank you for this conversation, Josh. It's really gratifying to have someone like you who's really in these issues say that that's what my article did, and I'm very grateful to continue the conversation with you.
Likewise, looking forward to it. Thank you again, Adam. Wish you luck during the busy week for all of us. Thank you all for joining us today. We have another event starting in 30 minutes on AI, creating resilient and inclusive economies. And then at 1 p.m. back at the Atlantic Council, I'll interview Spain's Finance Minister Carlos Cuerpo. And then at 3:30, we have an Argentina economic doubleheader with both the Economic Minister Caputo and the President of Argentina's central bank. Obviously, a lot to discuss with both of them, given the events over the past 2 weeks. Thanks all for joining us. Have a great rest of the day. Thanks.